So you will want to have a phone with a camera on it to take some photos. But welcome one and all to the webinar. Let me know where you're from and that you can hear and see me loud and clear. I've already got people telling me, Peter, we've got Bedfordshire, we've got Down Under, we've got Pinner, Chesterfield. Thank you all for this. I am going to kick off and start sharing the screen because there is an awful lot, as you're about to see, that I'm about to share. And I don't normally have so much content. Also, do let me know you can see and hear me clearly. Yes, you can, so it's fantastic. Melton Morbury in the house. Gummersall. Lee, I went to Full Net Boys School not far from Gummersall. Joseph, my friend from New York as well. Joseph, you've got a new venture, haven't you, in jewelry? So do put that link up on the website. Is this going live on YouTube or TikTok as well? No, Sarah, only on here, I'm afraid, not on YouTube or TikTok until later. We'll do a broadcast there later. Okay, so what do I want to say? First and foremost, the usual stuff. Please do not treat this as individual stock advice because I am obviously not speaking to you individually, and that would be a regulated activity to speak to you individually, to give individual advice, and it would be a very silly thing to do without knowing your circumstances. So it is for education, informational purposes only. I haven't shown this slide before, and it's an old one which I've repurposed. Why do I do investing? Now, most people do it for funds, obviously, pensions, and we will focus on that. But I do want you to think of investing also as something which obviously the end goal is freedom, financial freedom, and all the rest of it, a pension, which allows you to leave your job maybe a few years earlier. But fun and fulfillment are often overlooked. And of course, if you do incredibly well, you might have the opportunity to undertake philanthropy. But I think fun, as I said, and fulfillment, that comes from it, particularly the fulfillment from teaching your children. And, you know, I've started with my son at a relatively young age. He has lots of fun, don't get me wrong, doing other things. But I think that fulfillment is often overlooked. I think the fun, the enjoyment of it, if you look at somebody like Warren Buffett, he will tell you he absolutely enjoys it. And I do enjoy all of this. I enjoy talking about it on the media, talking about it in my government roles, talking about it to crowds and writing about it as well. And I want to try and infect you with that joy, okay? So it's not just a tedious thing like, oh God, I must do a will, I must get my life insurance sorted, I must get health insurance sorted, I must get a power of attorney sorted, all of those sort of things which are tedious. I want to try and infect you with some kind of joy about it as well. Okay, thank you, Arun. You get it more and more now. Thank you, Joseph, for putting that in there. Hi, Keith, and everybody else in here. I thought I'd put this in just to lighten the mood as people get in here as well. I don't actually do that. I sort of sit back with the markets. With the markets, they go up, they go down, perfectly calm. I guess learning that from people like Warren Buffett, or rather having that confirmed by people like him. By the way, I must also, I don't know if you'll be able to see this, show you this little thing, this little beauty, if I haven't shown you before. That's how much I enjoy it. I enjoy it enough that, and I think when you enjoy something, it just makes life a heck of a lot easier to get people also along with the journey. Investing is 99% of the time doing nothing. Forgive me showing you my legs, but it really is 99% of the time doing nothing. It's not like trading. Trading's the opposite. Okay, trading, you're constantly looking at the market. Investing is we're going to hold things for at least 12 months, maybe even 3 years. They're good quality companies, maybe even longer. Warren Buffett sells some quality companies for decades, but almost certainly 12 months, unless you suddenly discover that you've just bought BlackBerry before the collapse, you know. But that's pretty rare. That company's completely become totally defunct. So it is 99%, I'm afraid, doing nothing. And I found this old picture and I thought, well, how can I sort of show me doing absolutely nothing? And I did find a picture of it. Success in investing, and I'm going to teach you the psychology part of it as well, is just keeping calm. You might have a lot of noise. You might have reasons to be nervous. For instance, you're showing the Duke and Duchess around. Whatever it is, and your heart might be beating at 1 billion miles an hour, investing is that equanimity, is just keeping calm. It is not your first reactions. It is not to panic, and it is not to get bored. I can tell you another time more about this fantastic event where I was with the Duke and Duchess and showing them. That was in Mumbai, by the way. But that sort of depicted just that ability to keep calm, and you can imagine it was a nerve-wracking time. With investing, there are 4 things that can happen with your portfolio and with the individual stocks that make it up. Okay? Now, these 2 middle ones is noise, and you're just going to do nothing with noise. Okay, and I'll show you noise with individual stocks. I'll show you some stocks that I've not mentioned before in a moment on the webinar. With noise, you're just going to ignore it. The markets and the journalists and the brokers who get commissions and the newsletters all want you to get overexcited with noise. When the markets rise, you may either do nothing, or you might even add to your portfolio and your positions. This year was a classic one. Last year when the markets were rising sharply, the year before when they were rising sharply, were all times when there's absolutely nothing wrong with adding to your holdings. When they're falling, now this is critical, we only ever want the kind of stocks that make up a portfolio such that our first instinct when those stocks drop is that they're so good, I want to buy more of them. That is what investing is. It's not trading. That is what investing is. It is, these are so good, I want to buy more of them. That is the safest type of portfolio. The other type of portfolio is, I've got a stop loss and I better get out. It didn't hit the price target I thought it would. That is turning investing into trading, which is fine. It's just a bit more complicated and probably not for most people, and that's fair enough. And what I've discovered is 90% of investors, probably more, 95%, want to be the type that they don't realize it, where when the stock drops, they're actually happy, which is what Warren Buffett says he is, when his portfolio in stocks drops, because he knows he might be able to pick it up cheaper at a better price. And I'm going to give you specific examples of that and how I'm planning to do that with, say, NVIDIA. Definitely going to do it with Microsoft and Apple. And I'll show you why, but I probably wouldn't do it with a Meta, and I'll show you why in a second as well. That makes life a hell of a lot easier than, oh my God, if it drops, I'm panicked, I'm worried, what do I do now? So I'm going to break that down for you. Now, before we get into the whole crux of everything, I mentioned earlier that investing is also about fun. This is from research which has been done by economists, and I'm going to sum it up for you. You can take a picture of it if you wish, but I'm going to sum it up for you before we get into the nitty-gritty. You get your feet down, you get comfortable, you turn the TV off, you get your iPhone ready. We used to think that happiness, and that's what a pension is for, it's what savings and investment are for, ultimately to make us happy, okay? Because we've got enough money, we're happy. It used to be thought that roughly $75,000 per year is the plateau. If you've got that kind of income, you don't really get much happier having more. You might all think, bullshit, not true. What recent research has discovered from Killingworth in 2021. So the original theory comes from Nobel Prize winner Daniel Kahneman, okay? That's the original theory. The current theory is that actually more money can make you happier, but only if you're a happy person to begin with. If you're a miserable bugger to begin with, money ain't going to solve the problems. So that old saying about can money bring you happiness? Guess what? The answer's nuanced. It's neither yes or no. Yes, if you're not a miserable bugger. No, if you're miserable to begin with. Doesn't make a difference. Anyway, I thought I'd share that with you because I just think it's brilliant. In one screenshot, just some of these things are, I think they're worth printing and keeping just to remind us the most important things in life. Maybe book number 19 that I do will be full of stuff like that. So let's get into the nitty gritty of what we're doing. And just as a reminder, this is from the Financial Times, the top 10 underperformers. If you've got any of these in your pensions, AXA, Aegon, Bailey Gifford, Artemis, just be careful. Do not trust big brand names just because they're big brand names. This is the 3-year underperformance versus the benchmark, okay? Value of £100 invested after 3 years became £66. That's after one of the biggest bull market runs in history, okay? And that's global. We're not even talking, oh, maybe it's because they went for some tiny little thing, okay? Global. You might say, well, the world's been doing rubbish. No, it's not. The world markets have been doing rather well. So that's point number one I make. Just be careful. St. James's Place, always guaranteed to make people miserable. Fidelity, Lion Trust. If you've got any of these names, okay, JPM, BNY, so Bank of New York Mellon, JP Morgan Emerging Markets, just be very, very careful and listen even more so to this. Again, that's from the FT, 10 largest underperforming funds, three are underperformance minus 26. This was actually, it gave you £4 on every 100 after 3 years of one of the largest bull runs. And again, as I said, this isn't because we're picking cash market stuff. This is global stuff, and including emerging markets. You know, for all the people who think, no, I'll just go emerging markets, that's easy. Or UK, or global, surely that's the answer. Even North America, this one managed to mess it up. Okay, so much for the experts, which is why I want people to be educated. It's why all my books, all my Financial Times columns, all my TV shows have been about educating the individual. I'm not the only one. It's not like I invented financial education. I just promote a hell of a lot of it. So let me start off with, before we get into the individual stocks and more about the psychology of how you should treat your portfolio and the stocks that I like and what I think is going to happen, let's start at the top end, okay, the top of the market, okay. Hi, Jeffrey from Malaga, my friend. We've met when I was out in Spain when we did the Great Investments Program event over there. So let's start at the top of the market. Now, at the moment, there isn't anything really bothering the market. And that scares me. So let me tell you the normal things which would bother it. Lack of profitability of companies. Well, no, NVIDIA is the only company that they care about with profits. And NVIDIA is continuing to meet expectations. It's just had its earnings announcements. The market really doesn't care about earnings from GE or Microsoft or Apple. It really doesn't. I don't know. Well, I do know why, but it's so focused. The market can be irrational. It can focus on one thing over many others. So, oh, by the way, the reason for these logos, for those of you who don't know, all the things that I've done or been on the boards of, so my Bloomberg TV show, Chatham House board member, worked in the US Congress for Elliot Engel, current role for the last 20 years with Department for Business, lectured at Oxford as a fellow, and was on the board of, was a director of the United Nations Association UK. The point of showing that is to say, I'm going to bring all of that knowledge into what I see. Okay, to the markets, and only keep it to the markets. I'm not going to talk generic stuff about global politics. I want to focus it in on the markets like a laser beam. So at the moment, the markets simply care about earnings or interest rates dropping. Now, they're almost certainly going to drop in the UK because inflation has decreased unexpectedly. So it gives room to cut interest rates. Okay. So that means more money. There's only three parts of an economy. The government that spends. Well, if interest rates drop, government debt repayment should decrease. So more money for the government. Should also mean more tax revenues because consumers and businesses, they're the other two branches of who spends. Corporates will have more money because they're not paying so much in interest charges on the debt that they've borrowed to grow their businesses. And consumers will have more because they're not paying more on credit card debt and loans and mortgages. Okay, very simple. So that should mean better for the stock market in the UK. Similar story is going on in the US. Now, interest rates can be perverse. Interest rates falling could be a sign that the economy is in trouble. We're having to cut interest rates because unemployment's growing. In America, unemployment has actually grown. It's at a 5-year high. So you'd think, well, why would stock prices rise? The market will interpret the same piece of evidence in two different ways, depending on a whole plethora of context. At the moment, the context is if there's any talk of interest rates continuing to fall, stocks will keep rising. If there's any sign that interest rates have bottomed and we might now no longer have any more cuts, then the stocks will fall. But that's not how we're going to look for it. We're not going to get a torch and look for all that reading and narrative. I'm going to show you a far cleverer way that I use to find direction of markets more broadly. So we're talking at the top end. Whether or not AI is a bubble, is going to make profits, is going to earn, it's not my problem or yours. It's the problem for the board of Microsoft. It's a problem for the board of Meta, Apple, Amazon, Alphabet, NVIDIA. It is not our problem. Retail clients have this desire to, first of all, focus on a problem which isn't theirs. And then 2 years before something might happen, like a market fall because of overvaluation, just exit now and panic. Retail clients are probably the most irrational of all. So forget that. Secondly, war in Europe, that's the norm. Okay, that's the norm. So do not think, oh my God, Russia, Ukraine, we should be worried. You know, if you look at the stock market through the period of 2 world wars, started in Europe, Europe's good at this. It's the greatest export that's come out of Europe is global conflict. So it's something we're used to. That's just background noise. Stocks can do incredibly well. In fact, the business of war is incredibly profitable. Stock markets don't go up for no reason. And innovation often comes out of conflict. So to sound very immoral and amoral, I'm afraid that background noise of war is the market is tone deaf to it. Okay? Your own belief systems might make you think, bloody hell, this capitalism thing's really evil. But that's not what we're talking about. There is no molarity. That's why people in the money business like me are all going to burn in hell. Now, pensions and investments at risk from double bubble. We should never get complacent. Everybody seems to be really happy with the stock market. That worries me. Always worries me. But that's not the narrative that I care about. I don't care about narratives. I care about prices. Because simply put, investing is buying low, selling high. If that's the case, or buying low and just waiting and waiting as it goes higher, if that is the case, then surely what we want to do is look at those prices, which is what we're going to do. Narratives and stories, great as these are, they're meant to throw me off balance. They're meant to distract me. They're meant to make me make rash decisions, which is what I'm going to avoid doing as well. Paul, the carry trade, it's not on anybody's radar for impacting the stock market, probably an impact of 0.01% if those things are measurable. Not discussed pretty much anywhere. Might matter in a few years, few months, who knows. Has done in the past. Right now, no. Rearmament, global defense, I don't care about the sectors. What I care about is to drill below the sectors and to look at the individual companies. Whatever they are doing, whether they're making shoes like Crocs or fast food like Chipotle or advanced defense systems and cybersecurity like Palantir, British Aerospace, Rolls-Royce, Palo Alto Networks. I don't care. Just because they've got a sexy symbol and the story sounds great. Hey, you know what? They've doubled their contracts. Psst, they've done this. All of that is to tempt me into making bad decisions. Good decisions are made on data. They're not made on narratives and stories. So yes, you can take a picture of this all you wish, that there is this amazing spending going on. Surely we should be looking at this. And you'll see lots of analysts and journalists discussing this. Now, how do I know what I'm saying is accurate? Because how do I know I'm not just deluded and completely biased? Well, because again, we looked at the data. We looked at the data from Daniel Kahneman, Nobel Prize-winning laureate, Richard Thaler, Eugene Fama on this. We also looked at industry data, the stuff coming out of Warren Buffett on this, and said, right, is everything we're saying in line with what they've said? Yes, right, good. Because I'd be really worried if I ever said or thought something which contradicted a Nobel laureate or Warren Buffett or Jim Simon's best fund manager ever, because, and you should be too, because all of a sudden be like, shit, Alpesh has thought of something that the Nobel Prize winners haven't. Who should we go with? And I'll tell you now, go with the Nobel Prize winner. Okay, there's a reason why I invest and ride the coattails of Microsoft or Walmart or Costco or whatever. It's the reason is I learned at a young age I'm not that good to create a Microsoft or a Facebook or whatever. So I better just ride the coattails of people who are. Okay. So similarly with this, these are great, sexy stories, but until I see it on, and companies only have 3 sets of accounts: balance sheet, which is their assets; profit and loss account, profitability; cash flow, money coming through the door. And that's why there are only 3 types of crashes or bubbles. The ones where there is no profitability and somebody discovers it belatedly, i.e. .com crash. The assets aren't worth what we thought, i.e. 2008 financial crisis. Your home isn't worth what we thought it was. Okay. Or cash flow crisis, pretty rare, which is COVID. Got to shut your business down. There's no money coming through the door. Very rare. I mean, I wouldn't even have, if before COVID, I would have thought, I don't know, what causes a cash flow crisis? To So that's where we are with that. All right. Now, here's some good news. Mike Wilson, who the hell is Mike Wilson? Morgan Stanley. Okay, it doesn't really matter. He thinks the S&P is going to rally 16% in 2026. Now, that's good news. But I'm not trying to sell you a retail, hey, and therefore come to my retail fund, buy some stocks through my brokerage. I couldn't care less whether it rises or falls. I could, in the sense that I'd rather make money than not. So I'd rather the market went up every day, every year, every week. But the fact of the matter is, now and again, I know I've got to take an inoculation jab of the market having a down year like 2022. And sooner, it's like when you're doing Formula One racing, you're going to have to do a pit stop sooner or later. In every race, you have to have a pit stop. I think in a Formula One, you got to have one or two. Okay, so think of it like a Formula One race. I'm going to have a pit stop and take a breather at some point. It might not be next year. It might be the year after. I don't know. It doesn't really matter because we know we've all got to do one. Looks like what they're saying is 16% over the next year. How accurate is Mike Wilson? Okay, how good has he been at this in the past? These are all questions you might want to ask. Quite frankly, I couldn't care less. I thought I'd share it with you. I don't think he's unreasonable. I don't think it's a red flag. I equally think he could be wrong. We'll see what happens during the year. But what I do know is, why am I so relaxed? Because I know I've got a portfolio of companies which, if the market goes up 16%, they should go up 32%. And if the market goes down, I've got a strategy, which I'll share in a second, of either going into cash or buying more of those stocks at a cheaper price, and then I'll make my money the year after. I'll just have to wait a year because I'm in the pit stop next year. Got it? Very calm. Now, you need your money next year. Well, investing isn't for you because, bloody hell, if you need your money next year, you better keep it in a bank account, obviously, right? Take a picture of this. I'm not going to go into all of this, but this is essentially what Morgan Stanley think. Now, this isn't relevant. I've got a master's degree in economics and in politics, and I can tell you this is not relevant for what's going to happen with stocks. It's background. It's what's driving it all. And it's all nice to read, but it could have been something else driving my stocks. Doesn't really matter in a way what's driving it. It's actually pretty positive, all of this. When I look at this, let me sum it up for you. AI, global growth, lots of spending, lots of good monetary policy, which isn't, i.e. interest rates are low, fiscal policy not too tight, you might disagree, which is basically tax rates are not breaking the back of people. Who knows? Maybe governments are getting better at this shit. And there's quite a lot of deregulation coming out of the world's largest economy. Great. So for me, there are only two asset classes. Okay. Stocks and cash. Simple. If you want to take less risk, hold more cash. Sliding scale. Most people complicate it with, well, I've got my properties, I've got my cash, I've got my stocks, I've got to have my funds, I've got to have my Bitcoin. I keep it really simple. Stocks, cash. Everything else, property, gold, Bitcoin, separate basket, my Vegas basket. I don't think of my trips to Vegas as part of my assets. Okay? This is pretty good. What you're seeing on screen, crude oil below $60. Okay, there's a problem that copper is at all-time highs. It's just actually it's a reflection of global growth, which is pretty good. What's the downside? There could be some recession somewhere. I mean, the UK growth has been pretty anemic. Recessions are good for stocks because the bottom of a stock market is usually the start of a recession because the data is lagging and we only find out in the rearview mirror we're in a recession, and the stock market works on forward look. We're not even there. I mean, I don't even know why I'm talking about recessions. So that's where we are. I mean, could there be some unforeseen things, a nuclear bomb somewhere, terrorist attack, spike in inflation because of energy prices? Hell yeah. Look at the world we live in. Look at who our leaders are. There could be all sorts of things. Maybe we've just been lucky that the market's been so resilient. Essentially, as the big companies keep spending trillions, we're fine. The companies are now replacing governments in the kind of firepower they have to spend money. Some of these companies have so much money, governments can't compete with them. In fact, some of the companies are larger than the annual GDP of whole countries. Okay? 2026 investment outlook, put another way, and I agree with this, The tariff rate has had no impact. So this is what I'm saying. 99% of the time, you don't have to do anything. I'll mention some stocks in a second. 99% of the time, you don't actually have to do anything because everything that's out there in the news isn't actually suggesting that the music's about to slow or stop. Okay, there's 100 trillion in global debt. Do I have to do something today? No. Is it a problem? Yeah, but not for me and not for my portfolio and not today. Is it a problem for me, my portfolio today? No, then forget about it. Okay? I like to keep my brain as underused as possible because I might need it one day when I'm older. My point being, I can worry about each of these things and write you wonderful letters and essays and analysis on all of these because I've got the qualifications for it. But that is all irrelevant to my portfolio and what I need to do today, which is beautiful because you think, oh God, I've got all this stuff I could write and think about, and I don't have to think about any of it. 9 out of 10 G10 countries cut rates in 2025. The biggest threat is that their cycles bottom out. The Japanese are raising their interest rates and the others follow in 2026. Okay, fine. We'll wait until it happens. I don't need to worry about something 6 months from now or 8 months. Today, 27% of S&P 500 capital expenditure comes from 5 AI firms. Fantastic, because they're really big firms. What if I said that they're all reliant on one government? Just because number 5 is small and 1 sounds even smaller, don't let that panic you. Those are very big companies. Here's putting it another way in a bit more detail, and I'll explain this in very quick terms. The tariffs are not a problem. You might think it's a problem, all this government debt. You might think it's a problem that so few companies are controlling the global economy. From a political standpoint, yes. From a stock market standpoint, no, because I own those companies. So I'm really glad they're monopolies. Okay, I'm really glad that they're bankrupting their competitors because it's good for my portfolio. And you might say, well, you're evil. Well, if I wanted an ethical portfolio, I wouldn't be a capitalist and I wouldn't be owning any shares at all. If I wanted an ethical portfolio, all this bullshit about ethical funds, no, ethical is not even being capitalist. It's Christmas. Read the Bible. Camels, eye of a needle, chances of getting into heaven. So all this ethical, either you can be a hypocrite or you can be invested. You can't be both. I'm invested. It's immoral that these big companies that I'm investing in are like the mafia. They're monopolies. Meta, Microsoft, Apple, Amazon, Alphabet, even Palantir, Palo Alto Networks. They would happily destroy your business. And we know Amazon does it all the time. There's documentaries on it. So I'd rather be, when it comes to investing, on the side of the mafia than the little guy, I'm afraid. Okay? Yeah, it's that immoral. And that's what you're going to be part of when you're part of this. Now, mega trends, great. Sustainable investing, holistic approach to energy transition, more nuclear power plants, more wind farms, whatever it is, they're finding solutions. For me, all it is money's moving around the economy. That means stocks are going to do better. Because when there's money moving around the economy, not too fast, not too slow. Too slow means recession, stock market falls. Too fast means inflation, bubbles. We're just moving at the right space. And whether that's being caused by AI, energy, defense, doesn't really matter what's moving the wheel. Okay, the wheel is moving. Now, if I wanted to try and solve some of these problems, I'd go into politics. I'm not in politics. I'm here speaking to you. Okay, so again, I'm not going to worry about things when it comes to investing in my portfolio that I don't need to worry about. I'll do that through philanthropy. I will do that through working government. That's separate. Don't mistake the things which are right and wrong with your portfolio. Otherwise, don't have a portfolio. If you want to do good, just get rid of your portfolio and become a hermit. Probably one of the easiest ways to do good. These, according to Jefferies Bank, it doesn't mean they're right. This was at the end of August. These are their Sweet 16 stocks from hedge funds. Now, why have I said hedge funds? There's, just like in medicine, there are two groups, aren't there? There's general practitioners, and then there's surgeons and specialists. Okay, surgeon and specialist probably takes 10, 15 years to get all your qualifications. GP, go on strike, drop out of medical school, boom, you're a GP. Thanks to ChatGPT, I probably know more medicine than the average GP. Okay, you and I both. Surgeons, no, clever. Same with finance. Long only retail fund managers. My secretary, who worked for me for 2 years straight out of university, then went on to become a fund manager managing hundreds of millions at Newton Asset Management. Okay, retail fund manager, GP, anybody can do it, including my secretary. Hedge fund manager tend to be more of the elite end, all right? That's why we charge 20% of profits that we make for our institutional clients. We charge a hell of a lot, just like a specialist would on Harley Street. These happen to be the Sweet 16 or the common stocks most widely held, according to Jefferies. Now, I don't own all of these. I'm not necessarily interested in owning all of these. Some of these are too volatile for me, and maybe in hindsight, I should have owned them, like Intel, for instance. Or Tesla, I don't own because it's too volatile. I know it'll do well going forward. Intel's got a great story. The president's backing it. Okay, but I don't like the volatility of something. Netflix, I've never had, even though I know it's been one of the greatest stocks ever to have for a long time. As you will know publicly, I own Alphabet, Meta, Amazon, Microsoft. I still have some PayPal from a long time ago, which is always a reminder of just how far companies can fall. Adobe I don't have, I don't believe. Don't think I've got Qualcomm, but I might be wrong. NVIDIA, of course, I have. Apple, I've got. Broadcom, I've got. That doesn't mean you should go and buy the things that I have. I have a lot more besides that. I have about 40 in total. My son and wife also. Uncles and others have different stocks. Generally, we're trying to do equal weighting. That doesn't mean you go and do this. And I'll come to UK stocks in a moment. By the way, before I do all of that, quick, I've got a segment in here. I should have put a title slide, personal news. I received, would you believe, a Lifetime Achievement Award. That means you're old. You're never going to get another award ever again. This is from the Department for Business and Trade's Head of Entrepreneurship. Department for Business Trade, Head of Entrepreneurship, Michelle Davidson-Jones, awarded me the Lifetime Achievement Award. Should I tell you the irony? It was at Rathbones, the pension provider. It was in their offices. And given how I have a go at pension providers all the time, it might be somewhat ironic. Anyway, I also, separate event, not the same one, met Deborah Meaden. Now, she's an angel investor. I don't like angel investing. I've got some angel investments. I don't like it because, unlike with listed stocks like Microsoft, Meta, Amazon, you can press a key on your keyboard and exit. With an angel investment, you can't. I was discussing a bit of that with Deborah. She's such a lovely lady, really inspiring. And you know, the sort of, if Britain had 1,000 more Deborahs, this country would be 100 times even better. Okay. Anyway, I've got this coming up. I will share the insights with you. JP Morgan Private Bank have invited me to their 2026 Outlook. So keep coming to future webinars because they're going to be different, and I'll tell you this. And they've got their chief executive from their global private bank speaking to talk about the AI revolution as well and what they think is going to happen in 2026. Now, the reason that's important is not because of who's speaking and that it's JP Morgan per se. It is because they can move trillions. They're the world's largest bank. So as what they say directs the money that they control and the money they advise their clients. That's why. So it doesn't matter whether they're right or wrong. But it's like being Russia. It doesn't matter whether you're right or wrong. Might is right. In finance, the might comes from the size of the money. You make it right. Okay. So that's going to be interesting. And like I said, I will share with you the insights. So do come to future ones. I'm also going to, just before I dive into everything, just say if you've got any questions, just email Paresh anytime. We do have a live 24/7, and I mean live, like real person, not an answer phone. Well, it's not the same person 24 hours a day, obviously. Details of the offices. If you want to send Christmas cards, that's where you send them to. You can send them to our Zurich office, but I don't go there that often. I was supposed to be there this year. Some of my other colleagues. All the free resources are here, okay? All the free resources are there, and some of the team from Switzerland. Now, let's get on to the individual markets and so on. One of the positive things at the moment I want you to take away from this is, well, first of all, this bull market is not particularly long. I mean, it sort of is and sort of isn't. It's sort of in the middle. And the returns for a bull market are actually they're not outstanding. There's a long way potentially to go. But one thing we should be aware of within all of that is, and a bear market is a drop below, strictly 25%, but I think they've marked anything with 20% or lower. And they happen. But look how infrequently they happen. We have nothing to fear but fear itself. The point I would make in applying that from politics to economics is how often do the newspapers and everybody else fear bear markets? Yeah, if you look at it, that's since 1970. I was born in 71. So that's since all the way back then. And they happen fairly rarely, okay, those falls. And guess what? They're pretty short and sharp. Okay, you've got a 21-month, a couple of times a 31-month, 16 months. But then you've got some 1 month, 5 months, 3 months. That fear of it happening lasts a lot longer than it actually happening as well. Okay. No, because we invest in US stocks. So we would have that problem if it was UK stocks. We couldn't even on day one when we launched the fund in 2004 do UK stocks because there'd be a liquidity problem outside the FTSE 100. So no, it's not been a problem because US stocks are ridiculously liquid for our size anyway. And the kind of companies we're investing, which are largely S&P 500 in any event. AI stocks are behind 55% of the US market gains. In a way, okay, that's interesting. It's the AI related stocks. Total market cap of market capitalization, i.e. what are the American companies worth? $70 trillion. Let me put that into context. The US economy, I think, though please somebody look this up on Google, is about 30 trillion, is it now? It used to be about 24 when I used to look at it. I think the EU without the UK is around 22 trillion and the UK is about 4 trillion. Somebody can put those right numbers in. You can Google it and put them in. So UK and India are about 4 trillion. UK might be 3.4 trillion. But yeah, somewhere between those. So that puts it into context. The total market capitalization of the US market is significantly larger than the GDP of America. So its stock market's bigger than America. And you might say, well, it's overvalued, it's overvalued, it's overvalued. Yeah, well, you can either stay out of the game or you can be in it. You can be on the train or off the train. It's up to you. But you can't have it both ways. You can't say, I only want to be in when it's not overvalued. Well, good luck to you. Go get a time machine, go back to 1917, okay, which is when it wasn't overvalued. AI's stock share of the US stock market, does that worry me? No. And I'll tell you why, because I've got an exit strategy. I've got a very simple exit strategy. It's either time or money, well, or price. Time or price. I mean, there's only two things in the markets anyway, time and price. Okay? Time, if it's a model portfolio we hold, it'll be 3 years, 4 years, 5 years. Hold it 3 to 5, like a house. Okay? If you bought a house today, unless you were flipping it on a refurb, assume you're not. Well, not today, sorry, in the 1980s, because the stock market's like that, you'd sell it in 3 years because you double your money then. And if there was a recession, you'd have to wait 5 years because you double your money then. Or you might not sell it at all, might hold on and do another circle. But so that's time, easily taken care of, or price. And I'll come to, Arun mentioned it, Daddy Bear or not. I was right, 30 trillion. Thanks, Raj. So I was right, sure. Because these numbers change so often, sometimes you forget where you are. Which is about, 7 times larger than the Indian economy and the British economy. So just to talk in terms of scale. Now, there gets a point. It's like a business. When you get to that size, small shopkeepers and a Sainsbury opens up next door. Guess who's going to win? Do you see what I'm saying? Britain is, in stock market terms, a nation of shopkeepers. I'm sure somebody said it before. Napoleon. And America is Sainsbury's or Walmart, okay? Now, top 10 performing stocks. What's possibly happening, but don't get overexcited about all of this, is there was a story in Bloomberg, which was, and I was at Bloomberg's headquarters just recently, the two best financial organizations in the world are Bloomberg and Financial Times. Financial Times is getting a bit political, so it's not as good as it used to be when I was writing for it. But Bloomberg is still up there, okay? Although it's also getting a bit political, but ignore the political crap that they keep writing. focusing on the financial, they're number one. They're objective. They're straight down to business. So this caught my eye a bit, that these were the ones which had done well in the first part. And then since then, there'd been some rotation. Now, if I've got a bunch of stocks, I'm not going to trade them each month, because that's trading. It's not investing. And that's the paradox of investing. You get new information and you're not reacting to it. It's both the paradox and the benefit of investing, I'm afraid. Otherwise, you're trading. If you're trading, go ahead. But this is not the webinar for you. Go change things every month. Go chase a sector rotation. Might as well, I don't like it. I want both worlds. Yeah, so do I. I can't have both worlds. I've got to pick a lane. Okay? And we're not trading. You might as well, better to trade. Go, great. You can leave the webinar now and go trade. I can do separate webinars on trading, but they're very different. So going back to investing, let's say for argument's sake that these are now suddenly going to become not as good as they used to be, and these are suddenly going to skyrocket. To me, it doesn't matter, because we've already analyzed those initial set of companies. I don't own these. I'm trying to think which of these I own. I have that. I don't think I have AppLovin or Lam. I don't have Lam Research at the moment. It's one of those I've had on and off in the past. I don't have Palantir because it had just IPO'd and we didn't have enough data on it. Wish I had it in hindsight. Didn't, because I don't do post-IPOs with little data, I'm afraid. Anyway, the point of these, and I don't know if Micron's in the Quality 5 Plus, so assume that I don't have it. Okay, and I certainly don't have SanDisk, Robinhood, Western Digital, or Warner Brothers. So looking at that, and you look at that, you say to yourself, well, wait a minute, shouldn't you just be shifting? No, because when we created a model of the portfolio, we already knew when we bought the companies that we have, valuation, growth, dividend yields were all set, and they'll go through cycles of being the hottest sauce in town to being the worst, okay? That doesn't mean you can pick any random companies. You still need to pick the ones which began undervalued, good growth, dividend yields, long track record of doing that, strong momentum, long track history of high Sortino. In other words, high average returns, low downside volatility, quick recoveries, etc., 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 etc. Once you've got those, you let their board of directors solve the problems of the world and how things are moving. You don't keep moving around. So again, I'm telling you something which says you don't do anything. I keep telling you, you won't be doing anything as long as you've got the right companies. I think we've got that in the Quality 5 Plus. I think I can't remember which ones. AI training compute doubles every 6 months. This is the bit which, just as an aside from investing, just as people talking, I think we're underestimating. Now, that's not going to change my investment decisions. So I'm talking to you outside of investing. I think the rate at which what AI is doing, and I know in my own business, and what we're doing with portfolios, how quickly we're able to check all our data, double check the portfolios, analyze what we're doing as humans, and then reanalyze, recheck it, or find opportunities which previously would have just had to let go because we don't have the manpower to do it. How quickly that's happening. I grew up in an era where Windows might change every 2 or 3 years, Microsoft Windows. Now this stuff's happening every 6 months. It's like, oh, they've got a new version of this, of the AI, new version of this. And it's like the stuff we look at and we go, oh my God, you can do that now? So I've now got staff members who I'm never going to let go of because AI gives them superpowers. And I've got others at the bottom of the pile where I'm thinking, I don't know what work to give them because they're not creative. If they're not creative, then AI is replacing them. And I've got 1 or 2 people who aren't creative. They're crap at being creative. They're the type. So anyway, there are some issues. But what I'm saying is this is going to be amazing. The world's top 10 companies by market cap. Now, you all know I own some of these, okay? I don't have Aramco. I don't have Tesla because I don't like the volatility. I don't think I've got Berkshire Hathaway. A bit too slow. It's fine, but a bit too slow. Okay. The size and scale of these is so big that they are removing the earth. But that's not why I bought them. I didn't buy them on a story. I bought them on the data. The data was they came on our database, undervalued, high growth, dividend yields. Now, most people, they could pick one of these and they're going to mess it up. they're going to, well, first of all, they don't have me looking over their shoulder. They're going to mess it up because they're going to panic and they're going to get bored. I guarantee it. 2021, Microsoft went up 53%. Everybody on this webinar would not have captured that, even if I told you in January I'm holding it, and you thought, oh, I'll copy Alpesh. Not that you would copy me just for the sake of it. And the reason is, for 9 of those 12 months, it was either going down or doing nothing. Down or nothing. So you would have got bored or you would have panicked, and you wouldn't have got your 53%. I did nothing. I did bugger all that year, as ever, and got the 53% on Microsoft. Because I didn't have to do anything. And trust me, doing nothing comes naturally to me. I'm really skilled at it. This is Warren Buffett's portfolio, Q3 2025. Doesn't mean I go and buy this stuff. I don't think I own any American Express or Moody's. Moody's has been great in the past. We've written about it in the past. I don't happen to own any at the moment. Then he's got 31 smaller holdings, some of which stink. United Health Group, though conventionally has always done well, but it had a bad year. And he'll tell you, he'll go, well, this stock had a bad year, so what? Warren Buffett has never had a single year where every one of his holdings has gone up, and he's never had a year where his holdings have been the biggest risers in the stock market. He's never had, where they've been in the top, say, 20 biggest risers in the stock market. None of his holdings have ever been in the top 20 biggest stock market rises of that year, ever. They've had good returns, but there's always been some tiny little penny stock which has gone up 1 billion%, which he's not owned. And he's never had a year where every single stock in his portfolio has gone up. And that's great, because that's how it should be. And he's not so clever that he can just pick one stock. Even he doesn't have just one company. Actually, half his money is in 4 companies: Apple, American Express, Bank of America, Coca-Cola. And that's 50% of the capital. Anyway, that's not to say you go and don't read anything out of that. This is just out of interest. There is nothing else to conclude from what I've just told you. Okay? This is now going back to the UK and the FTSE All Share and every single year. And I want to teach you something really important, which is going to make you rich. All of this, the whole point of all of this education is to try and make you rich. So this is from JP Morgan Asset Management. Okay, I get a lot of stuff out of them. I get a lot of stuff from Goldman Sachs. And I like to share it. So this is where we are, bang up to date data as of 30th of November, 2025. Okay. And what you can see, this is FTSE All Share. All right. Is, okay, that's up 17%, but it was down 13. Look at that volatility. That's a 30% spread. Okay. But the norm for the UK, yeah, your 6s and your 4s. When does it get a big number like this? Usually after a massive fall, down 33, then you get a big rebound. So overall, over a 2-year period, you're screwed. Over a 2 period, you're screwed. This is unusual. And the chances are we're going to get mediocrity again going forward. Okay? Because we've not had a crash. It's usually off of that period. 1994 to 98 was one of the rare periods where the UK market outperformed the US. But then again, 94 to 98, US was not exactly what you would have thought, oh, let's go invest in America. I mean, Microsoft, Apple was a shit show in 94. It was like on the brink of bankruptcy. I think Microsoft bailed them out. They gave Apple a shed load of money to help them survive. Okay, so that was a completely different world anyway. But that's where we are. So I've written an article on the blog, which is, if you go to alpeshwell.com, you'll find the articles about how frequently the UK ever beats the US for a second year. It's done it for 1 year. Next year, statistically, a bit unlikely. These are the UK stocks, which so far, as of this morning, data, have been the best performers. In the FTSE 350, that means the 350 largest UK companies, the 100 largest, followed by the next 250. I'm going to go through the charts of each of these and just give you quick pros and cons of them. I don't own any of these, just so you know. Okay, just so you know. A good friend of mine used to be a director of Close Brothers, Brian Winterflood, though sadly he passed away a couple of years ago. Lovely man. He was in my very first book, The Mind of a Trader, which I wrote in 97. And it's when I first met somebody who was properly part of the city establishment. So there are those. And let's see what they look at and what the pros and cons of them might be. These are the US S&P 500 biggest movers, but this is last year, as in 2025 to now, as of this morning. It doesn't mean they're about to do it again. The hypothesis isn't, if the stocks have been the biggest risers in the S&P 500 year to date, should we buy them? Have you tested that hypothesis? I haven't. And therefore, I don't buy things just because they have historically done well. I mean, Warner Brothers, classic example, it's in a bidding war. So the chances of it having another 171% rise are zero, because it's about to be taken over by one of two factions. You might say, well, no, there might not be. They might be left alone, and then they'll go up another 100. Well, no. So hypothesis is a scientific approach. Hypothesis, test it on the data. Okay, so let's look at some of the price moves of these. Let's start with those US ones, okay, which are these. So let me go through these really quickly on these, okay? Now, value growth income, great, ticks a load of boxes. Do I want it? No. I know Citigroup just gave it a buy rating, Bank of America give it a buy rating, but just be careful. Those banks give a buy rating to pretty much bloody everything. And their predictive force, I wrote about this in one of my Financial Times columns, their predictive force on buy ratings is pretty poor, okay? Is pretty poor. Their predictive force on sales is also poor. You think, oh, well, if everybody says buy, surely when somebody says sell, we should take notice. No, sadly, statistically, no. Hypothesis, data, test it, simple. Okay, don't just, well, I won't look at the data, I'll just roll the dice. We don't roll the dice when it comes to money. Money's too important for that. So where are we on Seagate? Not for me. Will it continue going up? Might do. I just don't like the fact that it's really expensive. And I've got enough in the same kind of area, hard drives, chips, technology, all of that kind of area. So I think I'm covered enough. So no, even though value growth income, it's okay. Why most people will mess it up, even if this keeps going up like this, I'll tell you, they'll either panic or get bored. What will cause panic? Panic will be when this happens. Boredom is this. And this has, what I look for in companies is risk. What's risk? You could look at value, growth, income, cash flow, which I do, but the other area of risk, which is often overlooked, a really easy, dirty, quick way to do it, is draw down depth, i.e. how much can it fall, and duration for it to break even. So depth times duration, there's your risk. Okay, and this, I'm afraid, the depth isn't too bad. Okay, it's 50%. Well, it goes with tech, but the duration, I don't like. What is it, 3 years? No chance. 50% times 3, that's 150. 150, too big. What kind of numbers do I like? Well, close to 0 would be nice, but those are rare. Okay, so overall, sorry, the road's too bumpy for me. Western Digital. Now, if I was taking a punt, I would have loved to have got in at that point. What would ever make me get into that? Only trading could have done it. Why is that? Well, because when the weekly and the monthly MACDs, which I'll explain what those are in a second, moving averages of the short and medium term prices are both rising, you can often get a really sweet acceleration as happened there. But that's really purely on trading. That's not looking at valuations and so on. And I'm not here to trade. And what about this continuum? Well, same problem as before. I know you've got all of these. I don't know who China Renaissance are, but they're giving their buy ratings right, left, and center. That could keep going up. I'm sure it could. And you might say, well, I don't have enough data, so I'll do it on a punt, Alpesh. Great, then, do it on a punt. For me, I don't want to trade it. I don't want to punt, and I don't like the depth and the duration because the number's well above 100. Because it's, what is that? 3 years times, again, probably about 50% again, 150, too big. Okay, Warner Brothers, ugh. The best time to get into Warner was probably around there, and then it fell back again, and yeah, like me, you would have looked stupid for about a year, and then of course it skyrockets because that starts moving up a bit volatile. I mean, now it's too late anyway because they've got the bid. Micron, 7 value growth income, but again, just like the others, exact same story. I'm going to keep repeating myself. Look at this, and this is the biggest problem with the biggest rises this year. Newmont. I don't want to be chasing last year's winners because I'll tell you what will happen if I bought all of those 10 stocks for next year. What will happen is some of them will crash. Some of them will continue rising. It'll be too random. Yeah, and that's too unreliable. Okay, and that, we've seen it time and again, all of a sudden, nothing. Okay, again, Palantir, great company. So I wish I bought it at the IPO, but I don't do IPO stocks. There's not enough data. In any event, for what is that? 2 years went nowhere, and then started doing well. And I said it time and again, I wish I bought it earlier, wish I bought it earlier, wish I bought it earlier. And then what happens? It just keeps going up. Do I think it'll keep going up? Yeah. Why don't I buy it? Just like Raj has asked about Lamb. I can't buy everything. Okay, simple as that. I go into Harrods. I would love to buy everything in Harrods. For a start, I couldn't afford everything in Harrods. I'd love to buy everything. You can't buy everything. So you pick and you choose. Okay, you can get a nice set of box of chocolates as a gift, really nicely packed in Harrods for £15. You can't bloody get that in Marks or Tesco's or Lidl. You can. Quality Street's £4.95 offer at Lidl. But anyway, Palantir is sort of a bit like me going to Harrods. Love to buy it, but I'm fully stocked. Okay. Will it keep going up? Well, the danger is it's cybersecurity, by the way, and they've got a lot of government contracts. My wife knows some of the people there, and they're the real deal. Lamb Research, again, there are times when I've wanted it, and it's usually always like this for a precondition, value growth income. But it's really when I see the momentum rising like that. But again, if you're fully invested, what can you do? The point with Lamb Research I'd make to you is if I don't have the spare capital, I don't have it, and I can't buy everything. Okay. So it's one of those, and so be it. But Lamb's one of those where if you've got the value growth income and you see the momentum rising, then fine. But it's also one of those where you really need to get out when that happens, when those drops happen. And I don't know when that's going to happen. It might happen now, starting next week. It might have peaked already. Okay. GE Vernova, not for me. Too little data from the IPO. Alpesh, you idiot, you should have bought it. Look how much. Yeah, in hindsight, I wish I did do IPO punts, but I didn't. I did cover it for clients and say, look, GE Vernova, a lot of these GE companies seem to be skyrocketing, but I've too little data. I keep to my process and my discipline. And I'll show you that in a moment, why and what the rules are. And I keep to my rules. Oh, you're missing out on some fun. I know. I'm really crap at having fun. Okay. KLA Corporation, great company. 8, love it. Bit worried it's overbought. This is one of the ones where if I had more, if I was looking to deploy capital, I am actually looking to deploy capital. This I'd put on my list anyway for it because, well, other than value growth income, drawdown depth and duration. But I don't look at things in isolation as individual stocks. I'm trying to get my students to learn. The individual stocks, I can give you an individual stock, like a Microsoft in 2021 or KLA today. You're still going to mess it up because you're going to panic and get bored. Because the one thing that private investors don't have is somebody looking over their shoulder and telling them, stop messing it up. So they mess it up time and again. I hadn't appreciated the importance of having somebody looking over someone's shoulder until I started looking over people's shoulders and realizing, oh my God, these people are going to screw themselves up. It's like giving somebody a Ferrari and they've never had a driving lesson. So yes, there'll be periods when it does this, but I probably hold through it. But that's not too bad as a drawdown depth and duration. That's not bad. It's a tighter stock. Tapestry isn't so tight, kills on the duration. So not one for me. I mean, you might say, well, that was a long time ago. Now it just keeps going up and up and up. I know, and it's got all of this, but thanks very much. I've got a lot of choice. Lots more fish in the sea. What about those UK stocks that we showed earlier? How have they done? And what's my views on them? I mean, look, Fresnillo, fantastic, might go up, but you can see how this is classic for a punt, not for a pension. Punt, not pension. I mean, we should do a quiz show where you show me stocks, I show you stocks, and then we go, marry, snog, divorce, what is it? Avoid, kill, Fresnillo. Okay, it's a 9. It's got some good financials up there. And it might just keep going up and up and up as long as commodities and copper and all the rest of it keeps going up. But not really one for my pension. Airtel Africa doing phenomenally well. Okay, doesn't meet our value growth income criteria. I'd be too scared of pullbacks. If I was going to have a punt portfolio, I'd put that in there, but I'm not having a punt one. Neither am I with Endeavour Mining, and you can see why it's shot up. Okay, or Babcock International. On the industrial side, great, value growth income, fantastic, but it does need a breather, and it might be right to start it now. So after this massive run, yeah, if you missed it, you missed it. The best time to capture these, or the best way to capture these, is just to keep an eye on this. And if it ever starts accelerating off, try and capture it at the bottom. But with this, you'd be waiting for years for that to have happened. Then it happened unexpectedly. So guess what? We missed it. So what? Don't care. Go do it again. Suddenly have this, no, we're not in the newsletter business. We go, oh, we think this, and then mention 50 other companies. No, not for us. Sadly, wish had it. Don't want it in the future either. Italia Mining either. Because if you can think of a hypothesis on which that should be bought, fair enough, but it doesn't fit my hypothesis. Value, growth, income, cash flow, Sortino. It's momentum and it's trading. It's not investing. So go punt away if you wish. But soon you'll end up having all your money in punting and none of it in investing. Okay, Hochschild Mining to the 7. Sorry, I've already taken an hour of your time. Okay. So shall I come to Broadcom? I don't care that any stocks in my portfolio drop by the historic amounts that they've dropped in the past. That's going to happen. Warren Buffett's portfolio dropped 50% 3 times in his career, and he became the world's richest man. I can't predict how much individual stocks that I hold will fall. I'll give you a classic example. I'll show you that in a second on here. Microsoft's only up about 5% in the last year. Microsoft's up 6% in the past year. Alphabet's up 60. There's a 10-fold gap between the percentage returns on my Alphabet holding and my Microsoft holding. Could I have worked that out at the beginning of the year? No. So why do I own both? Because I didn't figure it out which one's going to be doing better. And those numbers might not have been 6 and 60. They might have been minus 10 and positive 40. So I don't worry about individual falls because they're in the realms of, you got to ask yourself, are those moves either an opportunity to buy more because you like it so much, possibly, or do nothing, or sell, but only sell, not because you're trading, but because it's become a BlackBerry, i.e. obsolete. I don't think Broadcom's become obsolete. Okay, so a very simple decision-making process. I turn it into a binary decision and the decision tree, boom, done. Go and smell the rose off that AP. So that you can see they're very similar to this. They've all just exploded to the upside, okay, from downward trends and whatnot. And they've gone a lot further than they've historically done. Would we have forecasted that? No. Nope. We're not in the business of, we don't have an approach which forecasts these massive momentum surges. It is a 7, which is great. So on our systems, it would spike up and the momentum's there. But today is the question. Today, not 3 months ago. No, too much volatility, not enough analysis that we can do to cover it. Plodding along, but given the downward trend, not one for me. I prefer ones with upward trends to continue because then they've got higher Sortinos. So we're not looking at turnaround situations, not what we do. Notice how there's a lot of stuff we don't do. Retail clients try and find the universal theory of everything, and for every stock, try and have an opinion. I don't. If it's too difficult, Warren Buffett says this, if things are too difficult, he has 2 piles on his desk, things to read and things that are too difficult. The pile which is too difficult, he puts near the bin. The man, it's like he can read my mind, but put it in better terms, because I think the same. But I hadn't realized he put it better, which is he has a too difficult pile. And you might think, no, surely Alpesh, you're supposed to be an expert and have an opinion and a view on everything. Nope. God's honest truth. Again, I'll tell you something Warren Buffett said, and had he not said it, I wouldn't even have believed it when I thought it, which is, in this business, if you've got an IQ over 120 and the national average is 100, and if you spend 2 minutes on X, you'll realize that if that represents the national average, 100 is pretty shit, okay? Anything above 120, Warren Buffett said, you can just rent out. You don't need it in finance. You really don't. I can tell you that now. I've done things which are difficult. My university degree was difficult. This stuff isn't difficult because anything too difficult, like do I invest in line finance, value growth income doesn't hit the numbers. So it's going to be difficult to judge whether it's just momentum, whether it's going to pull back. Oh, no, leave it. Too difficult, leave it. Plenty more fish in the sea. I tell you what was really nice. This is on ITV. He, at long last, obnoxious little fellow is, I've met him in person, has started talking about the American market because he knows the UK market down here has done bugger all in 10 years. So 10 years there, sorry, £1,000 became 1,640, whereas 3,790, basically double on the US. So even he got it. Are we in a bubble? Now, I've got still a lot to do, so I barely paused. No, these are the warning signs, all the ones you're aware of. So I'm telling you now, valuations and so on. But here's why we're not. Okay, growth has got profits. Valuations are below past bubble peaks. Companies have strong balance sheets. Okay, take a picture of it. I'm not going to go into more detail. I'm not worried anyway. And if we are in a bubble and things fall, I'll show you why I'm not worried. These are the largest semiconductor companies. I thought I'd share this with you. And you can see AM's up there, NVIDIA, 4.5 trillion market cap, year to date up 34. That is up less than my Goldman Sachs, JP Morgan, and than my JP Morgan and Goldman Sachs holdings. So much for tech, and only tech, Alpesh. Okay? But Alpesh, that's really shit. 34%. Some of those other stocks you just showed us in the UK had gone up 1,000%, Alpesh. Oh, they hadn't. 500%, 300%. Yeah. That means British companies must be better than American ones. Fine. You saw the volatility and the drawdown depth and durations. And you see, I'm looking for consistency. I'm not looking for freaking roller coasters, turnaround situations, speculation, gambling. I'm looking for consistency and safety to get my money from. I don't just want a return. I want a relatively safe return, because a return by itself could be volatile instead. Yeah, they hold lots of debt as well. And they hold lots of assets which counter it. It's like me having, so we use American Express for our marketing spend. My American Express bill might come to £30,000. So it's not just debt alone. It's a very British thing. I didn't realize this about British people. Are very conservative when it comes to debt. It's the return on capital that you can get. If I can borrow at 3-4% interest, and I can invest and get a 40% return, as some of these companies can, on their capital, then hey, borrow all day long. Okay, so yes, you're right. They have a lot of debt, but they're net asset positive. Okay, so anyway, some other names, some of these we've already mentioned, so I won't go into all of it. You might not know KLA, which we mentioned earlier, is actually in that semiconductor business. Why would you know? I didn't know. Okay. Intel, obviously, I knew was. I just bought one of the sort of side hobby I have and I love doing is opening up PCs and changing things like graphic cards, which isn't difficult. Okay, but I like to tell my wife that it's really complicated and show her pictures, and then she thinks I'm a real man. Graphics cards, manly. Anyway, I just changed 2 of the NVIDIA ones, and I realized just how much more significant, and I've been changing NVIDIA graphic cards for about 25 years because they were the graphics cards company. I mean, there's nobody else doing the damn things, pretty much. And I looked and I thought, geez, even if I'm buying them and changing them, can you imagine the demand in AI? And this is the non-AI. I mean, they had some stuff where they said our graphics cards through AI can, make your eyes look in the middle and all of this. And it was shit, to be honest, because the rest of the computer let it down. The Intel microchip wasn't fast enough for the Anyway, the point being, the graphics card was brilliant. The rest of the computer's crap. It can't keep up with what's happening. So there's a lot to do. By the way, thank you all who are on the Wall of Love. That's at alpeshpatelreviews.com. All of you have posted. Any of you haven't, please feel free. We haven't finished. We've got a long way to go. So this is the agenda slide. Oh my God, I've really called this. This is me with the team discussing a whole load of stuff about entrepreneurship. And anyway, so I'm not going to go through this because I did this one last time. I want to go through more of the stocks and the S&P and the usual stuff. I've completely overshot on time, so forgive me. But what I do want to say to you is, and reinforce some of these points of what I'm going to do into 2026, is only have the stocks that I want more of if they fall, even more so in 2026, because we've had a phenomenal run in the markets, and God knows, falls are more likely than not. I don't care about the label. I want resilient companies based on valuation, revenue growth, high sortinos, because we're going to get more volatility, I would have thought, in 2026. And if I'm wrong, I'm still happy. If I'm right, and we get it, then I definitely want resilient companies like the ones I've already mentioned. Okay, definitely think portfolio, not stock. The biggest mistake private investors make, they keep thinking about the individual stock. They go, oh, my stock's down. And they don't think, well, wait a minute, the portfolio is okay. And that's because you're going to have two volatile companies, one of them falling, one of them rising. And that reduces the overall volatility of your portfolio. And if you take the one which was falling out prematurely, you've actually increased the risk of what's left. And I'll show you that in a second, and people just don't get it. And I've got a really good slide which explains it. Okay, I'm not trying to prematurely gamble or forecast what's going to happen in 2026. If it falls, I'm fine. The companies will take a pit stop. We'll just hold through it, maybe buy some more, rarely sell. And if it rises, well, then I get to spend more time in the middle of the Indian Ocean tanning those beautiful brown legs. Okay. Take a photo of this. UK pension savings, are you on track? This is based on the typical median UK pension pot. Basically, you've got less money if you're in the median, and it also tells you what you're supposed to have. It's been suggested. Okay. And you might say, well, my salary is shit. Yeah, but that's not my fault. 6 times your salary is what you should then have, even if it's a crap salary. You can't say, well, my salary is rubbish. I want 100 times my salary. Yeah, sure. I want fairies and unicorns making me breakfast each morning. But that's what they say. Okay. Won't go through all of it, but please feel free to take a picture of it. We put that together, and I think it's pretty good because it just sums it up in one place. And I don't know. I don't know about you, but I like pictures. I like pictures rather than lots of text. The other thing I want you to remember for 2026 is this. Okay, be careful about the fees you're paying. Be careful about, this is a new trick that places like St. James's Place are doing. They're issuing new funds, and then those funds are highlighting their headline fee of, say, 0.5%, but they're then taking your money and investing in their own other funds, which is where the real fees are of maybe 1%, 2%, well, maybe not 2%, but 1%. Okay, so they're hiding it under a layer, and they're only telling you the top fee, right? It's a bit like they're saying, oh, we bought this, you put money in this fund, and it's buying Microsoft, and Microsoft has lots of debt, and it looks like crap, but they're not telling you that, okay, except it's their own fund. And then that second fund invests in a bunch of companies. St. James's Place in particular, I've noticed, are doing this, and the regulators are too slow to pick up on this, and it's really shit, because the fees they should be telling you is all the fees they are charging you at whatever level of layer that firm are charging. They're not. They only have to tell you at the fund that you're putting it in. All right, so be careful of that double dipping. A lot of it's happening as well. Okay, now moving forward. Right, problems I'm going to solve. Okay. Crappy fund manager, I've already mentioned. Poor returns, we're going to do that by having a decent portfolio and then sitting back and doing bloody nothing. We're going to avoid the fees because we're not going to pay St. James's Place for a start. Okay, and I'm going to share the knowledge out of the rich and powerful. And this, when you don't know what to do, and this is an article from the newspapers, £1 trillion in muppet money costing service billions. People just don't do anything when they don't know what to do. So these are the people on here that I'm going to address with I'm going to show you the chart of the S&P, some more of the stocks that I like and hold, etc. Frustrated with pension growth is the number one email I get. Okay, occasionally get late starters. Some are independent thinkers who just want a second view. Very few are legacy builders. In other words, business owners who've sold their business for 10 million, 20 million, 30 million. I'd probably say about 2 or 3% of those. Dentists, lawyers, accountants, I get a lot of those. And then the smart DIY investor who says, look, I know how to do stuff, but I'm shit. I don't have a process. Okay, so this is for you. And this is, as you know, how we do it. We take 10,000 companies from London Stock Exchange, New York Stock Exchange, put it all through, make sure we can get all greens. If they're greens on value, growth, income, cash flow, Sortino, Alpha, so we look at all their accounts. Are they undervalued? I know there's lots of profits compared to share price, revenue growing, cash return on capital invested high, which is from Goldman Sachs Wealth Management, that croaky, lots of cash they're generating, but not spending much capital. Good momentum, that comes from the hedge fund industry, and Sortino, okay, high average returns, but very rarely fall. And if they fall, they snap back quickly. You put that together, you have an infinite number of variations you can do. So from 10,000 stocks, you go to 200. Out of those 200, you've got a lot of permutations, which you then are trying to achieve basically a portfolio of this and this. Now, that is not guaranteed in the future. I have to tell you that legally, but I have to tell you that ethically, and I have to tell you that realistically. No past performance is guaranteed in the future. You know that logically, rationally. You also know legally and ethically, I've got to tell you that, in case it wasn't freaking obvious. Anyway, it's not gravity. It's not pretty much guaranteed to keep going. Even gravity is not guaranteed, apparently. Physicists tell me. It's just a theory. It just keeps working, that's all. Drawdown, that's the most important number. That's actually the number you should focus on. I tell my wife when I show her the portfolio, I say to her, look, just because we've got that doesn't mean it's going to continue in the future. I tell her, assume half of that, which would mean 15% per annum, which would mean doubling your money in 5 years, not doubling it in 2.5. If you double it in 2.5, you got lucky. It's unusual, it's rare. 2023, 2024, 2025 are unusual and they're rare. You don't need me to tell you that. Go pick a history book up. So I tell her, assume we'll get only half of it, which means we double it in 5 years instead. And that's fine. Assume we will have 1 year in 7 where we make nothing, because that happens. Statistically, you just need to look at the most important thing to look at the portfolio level is drawdown of 10%. In a portfolio of drawdown of 10%, individual stocks can drop 50%. And if you think I can see into the future of which one of those stocks it's going to do, you're wrong, because I didn't think Microsoft was only going to go up 6% and my Alphabet go up 60. If I knew that was going to happen, I would have put all my money in Alphabet. I didn't know Alphabet was going to do double what Nvidia did, and my JP Morgan and Goldman Sachs were going to outperform Nvidia in the past 12 months. Otherwise, I would have put all the money in there. Right? Anybody who tells you any different is lying or deluded. Right? Why do I use what I call the approved list of 10,000 securities? It's just a modern day time-saving device. I should get a photo of myself doing that instead of, as I make the point to my mother-in-law consistently, we've got to clean a bit. Mother-in-law comes in, I'm chasing her with a Hoover. Modern time-saving device. That's all it is. Just a time-saving device. I can't go through 10,000 stocks. It's also a statistical device. Eugene Faber, the Nobel Prize winner, said you need to look at all the securities. You can't just look at UK-only funds picking from a small gene pool, because it's like trying to pick a World Cup winning team just out of Watford, which is what fund managers do because they've got so much money. So St. James's Place, Fidelity, they all let you down because institutionally they're set up for failure because they get so much money, which they want to get because they charge on the assets under management, that they have to spray it widely and therefore end up with too little money in too many stocks. Okay, for me, and if you want the minimum, it's 15 minutes a month. You might just check how your portfolio is doing. I know it sounds silly, but I told you at the start, investing is great because you're doing nothing most of the time. There's a video of Bill Gates and Warren Buffett talking where Warren Buffett says his diary's empty because there's nothing to do. The companies run themselves. It's for them to run themselves. Actually, famously, he said, always invest in companies where even an idiot can run it, because sooner or later, one will. Approved list, filtered, that's what we look at. One screen, one strategy. Value growth, income, Sortino, momentum. There are no sub-strategies of let's have a punt. That's separate. I happen to own some Bitcoin. That's got nothing to do with this. Okay, if I do trading, it's got nothing to do with this. I'm very clear about that to myself and to everyone else. One model portfolio, minimum. You can have just one portfolio. Some students have 2 or 3. And typically, there'll be about 20, maximum 40 stocks in there. That's it. That is it. Okay, it is this to that, to that. That's it. And then you sit back, nothing. Okay? Due diligence checklist, you must have a valuation factor, because we know from the Nobel Prize winners and the academic research that valuation impacts stock price movements, but it's not the only factor. This is where people who know a little get it wrong. They think valuation is the only thing. So when I read headlines about stock market overvalued, I think, it doesn't matter, because if there's high growth and strong momentum, it can be overvalued. It doesn't matter. Okay, the weightings of these increasingly over the last 25 years, that's probably become more important as a weighting than this. In the 1930s and 40s, that used to be the most important. Then growth got a higher weighting and momentum got a higher weighting. Okay, income dividends are actually 10% weighting. Statistical edge, that's just cheating. It's looking through the backdoor gate entry. high sortino, probably the most important. All right. Why value, growth, income, momentum? Well, momentum from the hedge fund industry is proven, and I'll show you some of the research in a second. Revenue growth. Companies that grow tend to do better than ones that aren't growing. Yeah, I know. Genius, eh? Undervalued companies tend to do better, but not guaranteed, than ones which aren't. So do you know where retail investors mess it up? They look for turnaround situations, i.e. companies which aren't growing. They look for momentum and ignore valuation, and therefore get companies which are overvalued and are about to crash. There's a lot of danger in all of this stuff. This, in a way, is what we're doing when we're creating that model portfolio. This is what Harry Markowitz got a Nobel Prize in economics for. That two investments, both going up. When you combine them, both have a certain risk. That's why they keep going up and down. When you combine them, you get zero risk. That's an oversimplification, but that's what you're looking for. You're not actually looking for inverse correlation. You're actually looking for non-correlation. Harry Markowitz, Nobel Prize in economics, that is essentially how wealth has been created by family offices and the super rich. The reason they have different assets, and within an asset, try to look for non-correlation between them, is because if they generally grow, then they're removing risk, increasing certainty, and still keeping the growth. As you can see from that, that is art. That should be on my wall. You can take an image of that. It takes a while for people to register what that is, but that is Nobel Prize winning stuff. 1953. Actually, no, I'm wrong. I don't know when. Somebody look it up when Markowitz got the Nobel Prize in economics. I think it was after that. How we do it? Very simple. We look at things like Croakey, which is from Goldman Sachs Wealth Management. What they discovered is companies generating cash. Somebody said, haven't they got lots of debt? Yeah. Guess what? Debt's not a major factor in company future stock price movements. Debt adjusted cash flow is, so after the debt, how much cash flow is still coming in and how much did they invest in capital? One ratio over the other. If they're in the top 25% of all companies, guess what? They go up 30% per annum. Not guaranteed, and not every company. As a basket, long-term average, 30% per annum. That's from Goldman Sachs Wealth Management. That's why I love those guys. Funnily enough, I love them not because of the reasons people think. I love them because they hire a lot of really clever quantitative people I could never hire. And they don't care if people like me steal their research. Because what? Does it look like I'm putting them out of business anytime soon? No. Pension isn't safe if it's unwatched. Just be careful. If it feels like it's on autopilot, you've got a problem. Okay? This is what we're after. That's my son at age 0 in his ISA. The goal was this. He's now 7. These are the contributions. Where is he? And this is if it was just 20% per annum. Where is he? Well, you know what's happened in the last 7 years with the stock market since 2018. So he's doing well because the stock market did well, not because daddy's a genius. Okay. 2025 happened to be a good year for him, especially in the stocks he's in, which, as you will know, because you watch my webinars and all the rest of it, a big component of what he owns is Meta, Microsoft, Apple, Amazon, Alphabet, and now over the last, since 2023, NVIDIA. Only since 2023. Okay, he had it for a bit in 2021, but in 2023, 2022, we're in cash. He got nothing in 2022, nothing in 2022. By the way, this is also why we do it. We've got a tool now which measures, if you go to alpeshpatel.com, it'll take you to the tool, which rates your pension. You can put in the details completely for free, what your pension returns are, and then we measure it against various models that we've got, and basically how much money you're missing out on if you stay the way you are. And it gives you a grade, A, B, C, D, E, or F, okay, based on how bad your pension is, on how much money you're making, and you could be making. All right, this is the other reason we do it. Again, if through this education, me giving knowledge doesn't diminish me, it raises you, okay? If you could improve your return by, say, 5% on a $250,000 pension, then in 10 years, you end up with 776,000. That's an extra $250,000. An extra $750,000 if you get that improvement, and an extra 1.3 million if you get that improvement. Here's the news. Since end of 2022, the S&P 500 itself has been generating 22% per annum. It's been doing that itself. Not to say it'll continue doing it. If it never does it again, at least you've got the bump up, and now you're compounding maybe only at this. Okay? Why IFAs mess it up? Portfolio risk. You're supposed to take more risk. I have 90% of your money in equities if you've got 25 years to retirement. What IFAs generally end up doing is shoving everybody into this bottom end. Okay? They make it really conservative. Now, for some people, that might be true, might be appropriate, but they're shoving you in the same category without anything bespoke, in the same category as a 90-year-old widow. Time and time again is what I discover. The ones who get pissed off and contact me are the ones who are saying, wait a minute, I want more growth, I want more growth, I want more growth. And the IFA say, no, because the IFA's only got in his bonnet, in his bag, 2 or 3 products to sell you. And those, or even what they call high growth products, end up being shitty little low growth British companies, I'm afraid. Okay? They put you in NVIDIA. They'll say, oh, no, let's shut him up. Let's shut up Alpesh. Let's give him some NVIDIA. We tell them, look, that fund's got NVIDIA. Yeah. They'll put 5% of your money in a fund which has 0.5% of its money in NVIDIA. So you've got 5% of 0.5%. This is why that, according to the data, is what a typical fund returns on 10,000 in the UK. 5% per annum. Well, I'm sorry. After inflation, you're getting bugger all on your money. And you've been told that's growth. Okay? They call 7% aggressive, which is a very British thing to do, to call 7% aggressive. I mean, making money is not seen as the dumb thing. Is your pension important? 9 in 10 UK funds underperform. You know this data. I'm not going to go over it again. High fees are a major cause, but actually spraying and praying, Scottish Widows, Standard, Chartered, St. James's Place, usually the problem. Okay, because they spray and pray too little money in small baskets like, oh, emerging markets. Yeah. And what have you actually put in? Where have you put it? And when you look deeper, you realize, well, they put bugger all in anything that's growing. This is from Goldman Sachs Wealth Management. This is really important. Okay. So please have a look at that. Sorry, this has gone on so late and long. I apologize. Let me know in the chat box if you want me to continue, or I should just shut up. Because we still haven't gone through the S&P 500. I'll have to change this webinar in future into 2 smaller ones, part 1 and part 2. I think this is too conservative, even though it's from Goldman Sachs Wealth Management. Years to retirement, 25. That's how much you should have. In equities, fixed income, just bank account. Okay, high interest bank account. So you've got 2 assets, stocks, bank account. That's Goldman Sachs Wealth Management. Okay, it's what they show their rich clients. Where you want to be. I'm still 90% in stocks. All right. This is the objections I hear from people every week. I'm too busy to do this. Can I do it myself? Should be, can I do it myself? I'll get it wrong. My provider will handle it. No, they'll screw you up. I've been burned by experts before. Yeah, absolutely. Because your average IFA is not a Nobel Prize winning freaking economist. We rely on Richard Thaler, Daniel Kahneman, Eugene Fama's work, Warren Buffett's work. You need fewer decisions. Investing should be as boring as brushing your teeth. Okay? And the trick, 10,000 securities, filtered, 1 portfolio, low drawdown. For a low drawdown, keep looking until the stocks are there. The myth, experts have a secret. No, they don't. Realize most predictions are a coin toss, even for cats. That was Jasper the cat. That's the expert, Neil Woodford. He was the fund manager. I'm not a retail fund manager. I'm not a retail fund manager expert by any means. I work for a living. Okay. That was me winning that competition in the FT. You can do it. It can be done by private investors. Okay. The biggest problem private investors have is market risk causes them behavioral risk, makes them emotional, makes them panic, and makes them get bored. They panic and they get bored. That's the problem. And they believe all of this. If you've been burned, your skepticism isn't a weakness. It's actually good. If you've been burned by an expert, it's because your typical IFA is rubbish. They're salespeople. They're trying to sell you a fund from St. James's Place. You're screwed. They might have other uses, right? Like they do all the things that I give you for free on the pension calculator tools and explain for free on there. Just go to alpesh.com. We've got a whole bunch of pension calculator tools on there. They do that for you. Yeah, guess what? They're busted because I've just made all those tools available completely for free. Don't even want your email address on there. Process. Okay, so let's go through some of this stuff. All right, ignore those bits for now. What I want to show you is, and I've explained some of this already, what I'm going to show you is why I think 2026, I'm not in something that needs to worry. Don't forget, all the tools are there. Rate your pension, pension calculator, safe withdrawal calculator, portfolio stress test. So I want to go to the S&P 500 and on YouTube. Also, please don't forget, 5.4 million views. Can't be wrong. There's a whole bunch on Fix Your Pension now on my YouTube channel, and 250,000 followers. 450,000 followers on TikTok. Please have a look at the videos on there as well. Now, in 2026, you're going to do path B or path C. Avoid path A. Path A is what people on this webinar will not do, should not do. People not on this webinar will do path A. Stocks will drop because they're bound to at some point. They'll panic sell market because they'll miss it and they'll have permanent loss. Path B is rational. Path C is rational. Either you're going to sit through it or sell half and buy back at a potential higher price later because you wanted the calm, or you're going to just sit through it. But the risk is it keeps falling. Okay, or you do 50-50. Path A is the absolute worst because it's the only one which leads to permanent loss. Take a picture of that if you wish. Now I'm going to explain the S&P 500, where we are in the markets and where we are going forward. For the S&P 500, determining direction, I don't do narrative and interest rates and macroeconomic analysis, debt analysis, fiscal policy, monetary policy, all the things I was taught on my economics degree, because none of it's relevant or important for it. What's important is prices, price movements. Now, I've been talking about this momentum. I'm that guy. Okay, this is Goldman Sachs. I'm that guy since I wrote this international bestseller, and that was before the millennium started. So before 2000, and it's in the book. Okay, how do we measure momentum on the S&P 500? All we're looking for is how close did the price close to the high. That's all it is. It's all what momentum is, because the higher it closed, whether at the end of the month, end of the week, or end of the day, the greater the probability next day, month, or week, respectively, it will go up. Okay? That's what momentum is. And the way we do it is using that little indicator. What we're looking for is the rise of momentum. It's not the only factor. This is for the S&P. I'm talking about for the S&P. For individual stocks, value, growth, income, cash flow, Sortino. For the S&P, the overall overarching macroeconomic condition is that. Okay? We're just looking for it rising to get in, falling to get out. Now, let me be more specific. This I've drawn, many students love. Where are we at the moment? We're still at 0.1 on this. Now, this is from earlier in the year. I'm showing you it from earlier in the year to show you it, and then I'll show you it brought up to date to show you it stands the test of time. We're at 0.1. In other words, those momentum prices are still rising. The risk-averse people might be cautious or stay out. If you're risk-averse, you decide. You stay out. If you're risk-neutral, like most people, you might add to winners, but cautiously. Because it's quite high and overbought. We're at 0.1. We're not at 0.4. We're not at 0.5. We're not at 0.6. We're at 1. Risk-loving will buy because they always buy. There's a 70% chance of a 10% drop in 6 months. Mark my words on this. Right? 70% chance of a 10% drop or more in less than 6 months. So by next June, I expect a 10% drop with a 70% probability. Not with certainty. I don't do witchcraft where I can make things certain in the future. We're at 0.1. How do I know? And these are the rules for that framework in any event. You've got 2 choices. Do nothing. Well, 3 choices. Do nothing, wait for a daddy bear, or wait for a mummy bear. What are they? Well, I explained what they are there and what the pros and cons and the risks are. Okay, and I'll explain in a second what a mummy bear and a daddy bear is. And by the way, this is all trend following, and it's not me who's invented it. Simple trend strategies work for the long term. That's Citigroup. Okay, that's Winton Capital. That's their slide, not mine. Trend following hedge fund based out in Hammersmith. Okay, and then what some of these people taught me when I wrote my first Financial Times book in 1997. Gets to the heart of the matter of trading by clearly elucidating method or a successful trading strategy while capturing the net problem. So I've applied that trading strategy to investing, just looking at a longer time frame. Okay. To the extent, I'll show you S&P in a second, to the extent, in the case of NVIDIA, what I meant about if it drops, I want to buy more, is simple rules. Okay. Look to buy more. This is what buy the dip is. You might rebuy cheap. You don't have to do these things. You don't have to take a picture of it if you wish. You don't have to do these things. You might just leave it and not do anything. But if you're being more active, then these are those. That's why when it falls, I don't do anything. Falls 8 to 18, might buy more. Has a steeper fall, I might then expect an even deeper fall. So sell a bit in the hope of buying back cheaper or do nothing. And then those numbers are where I'm really looking to buy more. But they might never happen. Okay? A lot of things might happen, might not happen. The trend lines, I'll show you those in a second. So let's look at the S&P. This is where we are. It's still rising. What's a mummy bear? Where that's falling. What's a daddy bear? Where it falls below its own moving average. Very simple. Where are we at the moment? Well, you can see where we are. It's still rising. It's like here. Okay, it's like here. But it could fall. Yeah, well, we'll wait till it does. It's like here. But it could fall. Yeah, well, we'll wait where it does. At the moment, it's still rising. Alpesh, are you saying it's going to keep rising? No, I'm not saying that. I don't know what's going to happen. Are you saying it's going to fall? No, I'm not saying that either. I don't know what's going to happen. What I know is not what's going to happen. What I know is what I'm going to do. What I'm telling you is, if it dips a bit, what am I going to do? I'm going to do another webinar and then decide at that point whether I start easing back my position. What if it crosses over like this? Then what am I going to do? Probably the same I did here, which is step out at the risk of having to buy back more expensive later. That's the insurance premium, but at the benefit of not seeing a deeper fall. And what if you're a little old lady who's saying, or man, saying, but I don't want to do all of this, too complicated. You don't have to. You can just sit through it, because we know that overall, longer term, the market rises anyway. So why do you do all of that, Alpesh? Well, because if I avoid that fall and keep my money fresh, I can take that ride. Whereas if I sit through it, I can't take a bigger ride. I have to sit and get zero. So that's the choice. These are the earnings which are coming out. Okay. These are the earnings which are coming out, which are this week. Okay. I happen to own that one, but it's because it's in a portfolio. Me telling you an individual stock, but not showing you the portfolio. It's a bit, well, I don't know what it's like, but think portfolio level. Don't think individual stock. So let's say my synopsis, which I had earlier in the year, drops out of bed, which it did. Am I worried? No, because it's one of 40 odd stocks. Was it bound to happen? Guaranteed one of the 40 stocks I own is going to drop more than 20%, because it's happened to Warren Buffett virtually every single year that he's took for him to become the world's richest man. One of his stocks in his portfolio dropped 20% in value every single year that he's had those portfolios. Retail clients panic. Warren Buffett and myself, we don't. Okay? So these are a whole bunch who've got their earnings. None of these earnings will move the market. Past week, this is how it's been over the past week. Okay? Now, look at that. This is all noise. 1 week is noise. When you hear about, oh my God, we should move into sector rotation, that's brokers sending you emails to get you to earn them commission. Okay? That's newsletters sending you emails to get you to keep your subscription. That's journalists sending you articles to get you to click on their links because it saves their job if somebody's reading. Me, I can tell you it's noise, because whether or not you believe me doesn't add any money to my bank account. That's noise. 1 week is noise. Statistically, we know this. If you don't believe me, Eugene Fama, F-A-M-A, Nobel Prize in Economics, proved it. Not the only one. Many others have proved it. Past year, however, that isn't noise, because that's when the economics and the fundamentals of the company come in. They've had 4 sets of earnings in that time. Okay? Now, at the start of the year, let me tell you what I got right and wrong. I got right in owning Alphabet and NVIDIA and Goldman Sachs and JP Morgan. What I got wrong was that Alphabet was going to go up 60%, NVIDIA would only go up 30%, JP Morgan would go up as much as 30%, and Goldman Sachs would go up 50%. God, you're shit, Alpesh. You didn't know how much they'd go up. The ones that I thought would go up the most went up the least. The ones that I thought would go up the least went up the most. Doesn't matter. That's why I have a portfolio. I don't have to worry about it. It's the portfolio's problem, not mine. That's why myself and Warren Buffett have a portfolio. Private investors, they're freaking insane. They want every stock to go up. And if something doesn't go up fast enough, they get bored and ditch it and then trade into the next thing. They make me look good. And Warren, okay? But Alpesh, you didn't get the 1,000, you didn't get any 10 baggers. No, I didn't. Sorry. But bank balance is all right, or pension balance is all right. Sun's ISA's doing fine. Now, I wish I had a crystal ball where I could get the 10 baggers, but I tell you what, here's a clue. If the world's richest man with all the resources doesn't do it and can't do it, that might give you a clue whether or not it's bloody possible. What are the chances Motley Fool and Seeking Alpha are able to do it? Pretty piss poor zero, aren't they? But they'll keep selling you subscriptions. So I'd rather do it my way, because the clues are pretty bloody obvious what's possible and what isn't. ETFs, I'll do a separate webinar on those. But these are the exchange trade funds. Would I buy gold today? Well, gold, I'm not a gold specialist. So I just asked my wife, do you want more gold coins? And she said, nah, I think we're all right. Don't want too much of it. That's my expert opinion. It's her expert opinion. She's not an expert in gold. Bitcoin, my wife bought some art recently, and I treat it the same way I do Bitcoin, which is in 10 years, it might be worth bugger all, or it might be worth a bit more. That's it. This is the UK market this past year. Very unusual. It's gone up and beaten the US markets. Doesn't tend to happen 2 years in a row. Since the Second World War, hardly ever. Since 1990, I think it's happened once. And that was 94 to 98 it happened. I've written a detailed article on my blog, alpeshpatel.com, for that. Okay, just some of the names. As you know, I own that. I won't buy that because I just don't like the volatility. I think after he went insane, I wonder actually, under the new UK regulations, he could be sent to prison for some of the things he says. Anyway, not that anybody's going to do it. Visa, MasterCard are sort of staple. They don't tend to grow as much as I'd like. They're not, I might have Visa, I can't remember. But then just assume I don't. But JP, as you know, I've still got. Okay, I don't happen to have any of these. Some have done really well like that. I just don't happen to have them because they didn't make the cut start of the year. Why not? Why can't you forecast every stock that's going to go up and by how much, and every stock that's going to fall and by how much? No, I can't. I can't even do it that in my own bloody portfolio, as I've shown you, when I've only got 40 stocks to do that with, let alone 10,000. And neither can Warren Buffett. So stop as a retail client trying to over-predict and trying to be over-smart. And when you read those comments from your IFA and wealth manager, which goes, well, we think this is going to happen, you know they're bullshitting you. Because how come Warren Buffett never writes that? All he's ever said is, I believe in America, and longer term, I think it's going to keep growing and make money. He's never said, well, I think we should go more into AI now. And in fact, the one thing he kept saying was, don't do tech. For the longest time, because he knows he's not an economic commentator or even a company commentator. What he's a commentator on is balance sheet, cash flow statements, profit and loss account, as he keeps pointing out. And his mentor, Ben Graham's book, was about those three things. It was about balance sheets. That's why he likes the price to book ratio. He values companies based on their assets, not even on their profits. He rarely, I don't think I've ever heard him talk about profit and loss, price earnings ratios, PE ratios. He talks about price to book, though, how much the assets of the company are worth. Okay, just checking. We've still got loads of people on here, and I'll keep going. Sorry, this is so long. I've totally mistimed it. I really apologize. FTSE 100 index, it's breaking all-time highs still, but in April it was at 2019 levels. This is unusual. Will it continue? Look, if you want the index trackers, you got FOMO with this or with Bitcoin or with gold, have up to 5% in your portfolio. But beyond that, I don't think it'd be necessarily sensible given historic performances. S&P 500, I've still got. Okay. Leveraged 2 times. Don't do leveraged. It'd be irresponsible for me to tell you to do leverage because it is higher risk and higher octane. And the reason you shouldn't do leverage is look at those drawdowns. You are losing within a very short space of time, 50 to 70% of your money. That's why people like me use the daddy bear rule on leverage and the mummy bear rule. We start easing when it becomes mummies and exiting when it's a daddy, because we don't want that drawdown. That is more work for you. It's a skill. It means correct interpretation. It means a discipline. And it means risk. You should definitely, none of you have leverage on your pension. Okay. And that's not reverse psychology speaking. Okay. Same with this. Now, that's a classic example of me now needing to have to pull the trigger on that and get out just in case it's going to have a big fall. Because historically, whenever that's happened, that occasion, this occasion, and that's it in the last 7 years, it's usually had a fall. It will eventually go up, but it's usually had a fall. So I'm looking to exit and buy back cheaper later. Amazon, probably similar kind of story, although this can rebound really quickly. So I might be a bit lazy and slow to get out of that. And it gives you lots of time. So I think I'll wait with Amazon on my 2 times leverage. Bitcoin, it is in what we'd call daddy bear territory, I'm afraid. So is it going to fall a lot and you should be selling and buying back cheaper? Or should you just wait and see it through? Honestly, I don't know. At this time there, during COVID, it just rebounded really quickly and you should have just stayed in. I don't know. For me, Bitcoin's one of those things like modern art. I'll just keep, I'm not, the only time I'd start buying more Bitcoin is if it drops to about 50-ish. If it goes down to there, I might pick some more up. Okay. Whoops. Total light failure. That's not your fault. It's because my batteries have all gone. There we go. Right, you can see me all again. So that's Apple, which I happen to own. Nothing to say. Why do I own Apple? Because when I look at the return histograms, other than the average returns, it's a buy the dip, because whenever it falls, it usually longer term goes up. That's it. Simple statistics. You might say, you bugger, you cheated. You didn't talk about the Apple Watch, the iPhone, the chips, any of the things the journalists talk about. No. So I'm not a journalist. Okay. Novo Nordisk, not yet. Not flattened. If that isn't flattened, I'm not interested. Okay. So just sit it out. You can see how it's a classic example of buy cheaper later, but not yet. Not yet. Somebody will get premature on it, but not yet. McKesson, okay, it's a 7. Yes, I happen to own, I don't want to give too many away, but yes, I happen to own. My overall portfolio has 40. I think I've only told you about 8 of those 40. It's the portfolio, because it'd be unfair to my clients to tell you the whole thing. They'd get a bit miffed. But it's really at the portfolio level that's important, not at the individual stock level. Okay, classic buy the dip, solid. Goes through all of that, goes into that. That's the number. People think it's this. It's not. You halve that. And this, you can stay calm through. That below 15 is ideal in a portfolio. And guess what? You just saved all those IFA fees as well. 9,000 global stocks, 9 to 10,000 value growth, income, quality, multi-factor, momentum, statistical edge, and then you're going to invest in the best ones. And that's what wins you prizes in international newspapers. De-risk through non-correlation, remove emotion from the equation. Should write a song. Why 20 to 40 stocks? Because that's what removes company-specific risk. You can't remove market risk unless you hold more cash. The best way to remove stock market risk is just increase your cash holdings as you get older. Simple as that. Okay, we've got free tools to work out what it would look like for you. Go to alpeshpatel.com. Wealth gap, it's real. Generally, I'm in American companies, not because I'm racist against British companies, but because that gap is conventionally what happens. So I picked a period, not the last 5 years, which you could argue have been quite unusual, but the 5 before that, which you would argue have been a bit more conventional, perhaps, normal. Well, that's what normal looks like. Actually, the last 5 years make that poverty gap look even wider. Why do I say poverty gap? I mean, if you're British, you're getting that, and Martin Lewis showed it on the chart. And if you're American, because you tend to be domestically invested, your wealth managers and IFAs are probably hopefully telling you to invest more in those kind of companies which go up. But even those American fund managers do piss poor. I get a lot of American clients, 20% of my clients are American, because their fund managers underperform the market because they have so much capital, they spray and pray as well, and they don't put enough in the growth companies. Okay. Well, YTFL, retail clients in YTFL, this is the point at which they buy belatedly. That's why they're asking me about gold and they're asking me about copper. Okay. And then they'll wait till panic just before it starts rising. That's your conventional retail client right there. Okay. I've written about all of this stuff. That's some of those 18 books, and spoken about it on TV, and written about it in my Financial Times columns, and said it time and again. You can beat the bloody fund managers, as I showed with that idiot, Neil Woodford, time and again. And they give them billions. Fund managers like him are given billions to manage your pension. They're given billions. And nobody goes to prison for it, let alone gets anything other than a slap on the wrist. 9.2 billion he was given up to 2017. When in 2004, you would have said, wait a minute, mate, you barely beat the cat. Yeah, and that's how the city works. Their job is to keep telling you that shit is normal and be grateful and pay the fees for it and give them the billions. And that's proof in one slide. And I've seen it. I've lived it. Okay, and there's proof. It's not about me. I'm doing fine. It's about all the people who keep giving their money to the next Neil bloody Woodford. I've done a lot more videos and more proof on this, Fix Your Pension, as I said, and there's a lot of TV stuff where I've banged on about it as well. Okay. As I always say at my webinars, if any of you'd like that hand-holding and the work done for you and the mentoring, and somebody giving you all the data of the approved list and the model portfolios, making it bespoke to your risk appetite and educating you and informing you, but you make your own decisions and you don't pay fees at all, other than just one-off, no subscription, no weekly, then join the Great Investments Program. Because, yeah, we can do it for you, but you keep your money with whichever broker you want to invest it with. But we give you the data and lifelong data and hand-holding. That's what we do. And we've got self-employed professionals, we've got business owners, DIY investors, and retirees. That's their challenge. That's our solution. That's their challenge. You're in one of these groups. If you're here, you are in one of those groups. It's as simple as that. Okay. So if you're in one of those groups and you want to be part of the program, I know it's pricey. It's going up again. We tend to put it up by the lower of the S&P or the NASDAQ, and those are both up about over 20%. So we're going to put it up again in Chan by another probably 20% as well, which is what I'm looking at for it. And we've been doing it since it was just £1,000, and we were proving the concept to people. And as we proved it, we went from 1,000 up and up and up. But on the webinars, we do discount. And what I eventually want to do is maybe even float this and challenge St. James's Place, who've got 1 million clients, take their 1 million clients and show how people can just do it themselves, give them the data, give them the model portfolios and say, right, and here's a bit of the education. Now you can do it yourself. Don't panic. Don't panic is one of the biggest ones. We give lifetime access for that. And the way I look at it is this: if you've got a 100K portfolio and you get a 15% uplift, even if it takes 1 year or 2 or 3, it doesn't matter. Those are the numbers. It's as simple as that. The numbers are great based on what you've got. And there's an educational program that's going to change. So I've left that blank. Use that coupon code. Go there or go shares too, because we often get a lot of people in there and the site gets blocked. So alpesh.com/shares. Okay. The investor's dilemma is this. This is the problem why most investors underperform. The panic, the fund manager having mediocre returns and fund managers charging you lots of fees, and you're basically investing in the wrong stuff. So your typical IFA isn't ticking any of these boxes, and that's the problem. Okay. Then there's been some talk about robo-advisors. They get 2 things right, everything else is shit. You're the closest to ticking all the boxes. All you need is the process and the data, which is where we come in, and the hand-holding, which is where I come in. I limit it to 10 at a time just because I've got a big team, but they do the back end stuff. I do the mentoring personally and the onboarding, and I want to maintain the quality. Do follow me on LinkedIn. I've now got 28,000 followers there, and I am a top voice alongside Bill Gates, apparently. And there's articles and some of the stuff that I've discussed there. Now, that is a place where I'll discuss maybe non-stock market stuff like the latest national security strategy out of the United States. I'll talk another time about my work in the US Congress many, many years ago. So I don't want you to buy, actually, funnily enough, the program. What I want you to do, first of all, is run the numbers on your own pension. I want you to have a look at the tools on alpeshpatel.com and run the numbers on your own pension. That's your plan. That's what I want you to do. The tools are here. Campaignforamillion.com and alpeshpatel.com are the same site. Okay? Run the numbers. That's what I want you to do. Just run some of your numbers and see where you'll end up, because that's actually the best thing you can do. Okay? It's just measure where you are. Because the first thing you need to do to solve anything, don't worry about that part, is the first thing you can do to measure anything, to solve the problem, is to measure the problem. Okay? I also want to say, so alpeshpatel.com/shares 2 will take you there as well anyway. Okay? So you've got a multitude of options. What I want to do by getting to, I don't know, 400, 500 people on here, we've got about 350 so far, is then have a substantial group of a substantial amount of evidence to show venture capitalists and say to them, right, I think this is now worth 30 million. Put 15 million into global marketing for it. For the first whatever group until we do that, they'll always have me as the mentor. Okay, me as the advisor, me as the, not advisor, me as the mentor, me as the educator, me as the teacher. On all of that. Okay, when did I start it, Sarah? In 2020. And if you want to see some of the interviews, and because obviously now we've got a lot of people on there, if you go to alpeshpatelreviews.com, you can see video reviews from people. If you want to see our performance since back then, so you go to alpeshpatel.com. So in 2020, it was £1,000. You can see the case studies, you can see the videos with people, but also if you go to alpeshpatel.com/shares, you'll see the past performance of some of the model portfolios as well. And this year's ones, because the market's done well, have done well. What was the worst year? 2022. Not that you've asked me, but I'm telling you, 2022. Why? Because we had to hold cash because the markets fell 25%. So we held cash. Okay, and you can read a bunch of reviews there as well on there. That's on alpeshpatel.com/shares as well. And you can see the performances and what the stocks were, and that's 2024. So soon we'll have 2025 up there. 2023, 2022 was 0. Okay, that's 2021. Back. Oh, sorry, from when we started it to 2021. Okay, of what happened. So you've got the time frame since it was launched up until 2025. Obviously, market's gone up. It'll be another bloody good year when we run the numbers and put the model portfolios up on that. So it's that. But we can't guarantee future growth. Legally, ethically, morally, logically, can't guarantee the future. I have to tell you that on all of those bases. Okay. Thank you all. I was too busy playing Warzone. I know. I'm crying I didn't come across you until 2020. Oh, Sarah, there's so many people who say that. Do you know what the funniest thing is? I wrote my first book in 1997. I had my own show on Bloomberg in 1999. Where were you then? My BBC newspaper reviews go out to 300 odd million people. People go, I never saw that. Financial Times column, 200. Weekly column in the FT. You didn't buy the weekend FT. Bloomberg TV show. You didn't watch Bloomberg TV. Why would you? You didn't go to the finance section of the bookstore and buy one of the 18 books. Why would you? So, TikTok's been a game changer for me, because TikTok is and YouTube are where everybody comes to me from. It's really weird. It's really, really weird. It's how everything's changed. So I hope that was good. I'm so sorry that's gone on for 2 hours. I'm going to go now. You can email me. Peter, everyone else, Merry Christmas to you all. I will do probably at least a couple more webinars before Christmas, because I think this is the time of year when everybody has got a bit of time. They're looking to sort themselves out for their New Year's resolutions. And because of the new year, they're looking to, tick a box and say, right, I've sorted this, that bit's sorted. New Year's resolutions, sort out pension. And this way they get it sorted. So what I'd say to you is, yeah, now's one of the times when I'll probably do more webinars, because there's a greater intent amongst people to focus on the stock market, sort their pensions out before the new year, and know, okay, right, that's taken care of. So that's why. So I'll do quite a few more for you all before then. It's also quite a period for me. Son's off school, it's a lot easier to do. Well, goes to bed by now, so do more webinars. So yeah, actually, it'd be good to know. Thank you very much, Glenn. How many webinars a week is too many? I won't keep them 2 hours in future. Let me know the duration, like what, 60 minutes, 30 minutes, 45 minutes, and how many in a week. Obviously, the answer is going to be 1, 2, or 3. I'm not going to do more than 3 in a week. And I'll update the charts and the markets. But this was way too long because I obviously put too much data into here. But yeah, I'll look to sort of change some of it going forward as well. But it'd be good to just hear you in terms of how long you think. I'm going to jump off, but anything you put on here after I jump off, I'll still be able to see, and you can always email me. And do have a look at, as I said, the tools. They're completely free, alpeshpatel.com. If you go there, it'll take you to Campaign for a Million, the website. And the tools, there you go, pension calculators, that's where they are. Okay, and if you click on that, you'll see all of those tools completely for free, and you'll be able to work out a whole bunch of really great things, including, you know, rate your pension as well. There you go. So all of this on there, and it'll calculate rating. They're really helpful, because the great thing about it is there's no mistakes. It's not like with an IFA where, oh, I could only ask him once, but what if I change the growth rate? What if I save more? What if I invest more? What if I retire early? Those tools will do all those calculations for you. And the great thing is you can just play around with them completely for free without having to think, oh God, the IFA's got to get back to me, got to get back to me, this is going to cost me. No, that's why I created them. And they've got a ton of free resources, including this webinar, which will appear there soon. And both written articles and video on all of these things. This is all completely free as well. Okay, so there's a lot of stuff there, and anyway, so self-explanatory. It's bang on and on about the same thing. Okay, peeps. Thank you all very much. Everybody who signed up, I'm going to send you an onboarding email straight after this, and then we'll set up our first call, give you access to the approved filtered list, the model portfolios, set up the call, and then I'll monitor and handhold you. Thank you very much. Outside working hours is good. As often as I like, good. I like this time for webinars. Missed a lot of the recent ones due to work hours. Fine. I'll try and do them later than 9. Mondays and Fridays, fine. 60 minutes twice a week. I like that. Yeah. Good. Okay, I think that gives me a pretty good idea. 2 to 3 in a week, and try and keep it to maybe an hour and around this time. Okay, thank you, Sushila Sharma, same first name as my beloved grandma. Thank you very much, all of you, for being on, and yeah, happy Christmas to you all, and peaceful, joyous time. When are we? Wednesday. So yeah, I might try and even do one more this week, but certainly next week. Obviously not Christmas Day, but do more during this festive period, maybe 2 to 3 in a week, and keep it shorter. So maybe break them up into 2 or 3 different parts, but always do the stock market update within those. I think that'll go well. I don't just want to do the Great Investments Program bit, but I want to talk about and give you the benefit of the broader market stuff, obviously, and there's a lot to cover, clearly. So go through some of this stuff on there with you. Okay, thank you very much.